Okay, ladies and gentlemen, thank you so much for joining us this evening, and thank you all for joining us who are participating on Zoom. We have such a distinguished audience today in both this hybrid format and the way of the future, and such a fantastic panel to discuss a critical topic today. I was in Washington last week for the IMF meetings, and I think inflation, the energy transition, the shocks to economic growth, shortages of natural gas are all top of mind for policymakers. So really honored to be able to welcome this fantastic panel today. So I will just take the opportunity to introduce our panelists. So to my left, we have Shaya Hossainzadeh, who's the founder and managing partner of Onyx Point Global Management. Shaya has been a practitioner in the energy investment landscape for over 2 decades, very distinguished career, working with W.L. Ross, and prior to that, Apollo. He is also a wonderful alumni of our joint alma mater, the London School of Economics. And I'm happy to report that all 3 participants here today have also a very strong engagement in the energy landscape, the environment landscape, in their out-of-office hours. To Shaya's left, we have Jason Bordoff, who is no stranger to many of you on the Columbia campus. I had the pleasure of meeting Jason years ago when you co-founded the Center for Energy Policy, and now co-founding dean of the Columbia Climate School, which is, I think, for some of the practitioners in the audience today on Zoom, also a key target for future and emerging talent. And a long and distinguished career, having worked with the Obama administration on energy policy, National Economic Council, National Security Council, and also a professor at SEPA here. And then to Jason's left, we have Professor Jeffrey Heal, who is the Donald C. Waite Professor at Columbia Business School here, and has made significant contributions to the theory of economics and environmental economics. And is also has also taught in Paris and has worked for the government of Sarkozy and holds an honorary doctorate from the University of Paris-Dauphine. So in the interest of today, a couple of housekeeping notes. What we will do is have the panel discussion. We have lots to discuss in kind of a truncated amount of time. Then what we will do for those on Zoom as well, this is being recorded, the panel discussion. We'll stop and have Q&A from the audience, both from the Zoom format as well as here in person. That portion will be under Chatham House rule in order to encourage a free debate. The definition of Chatham House rule, there is only one, there are not many, and having worked there over the years, which is that you can reveal the content of what was shared, but neither the affiliation nor the identity of the speaker. So if I say that investing in wind and solar is balderdash, you cannot say my name or my affiliation. And that part of the recording will be stopped. So Zoom will continue live stream, but that will no longer be recorded. And so I think also what we're going to do is cover some critical questions with regard to the economic environment in this current volatile commodity price environment in which we operate and make decisions. Secondly, we'll look at the geopolitical landscape and think about themes such as the role of energy independence in the relationship with geopolitics, the countries of the GCC, the energy exporters within the Middle East, the viability of these countries, their growth trajectory at the moment, the concerns around resource ties and importing and sanctions. And then thirdly, we'll look at some of the sector-specific dynamics related to the energy transition, as well as the whole energy mix, thinking about the viability of investing in wind and solar, thinking about the energy returned over energy invested with regard to the electrification of transport, thinking about some of the ESG implications in the current environment, as well as not just the economic and in the environmental, but also the social dynamics of the energy transition. And last but not least, especially for our students here today, we'll be thinking about some of the talent implications as well. So firstly, with regard to the macroeconomic environment, we've certainly reached a turning point prior to the pandemic, according to which policymakers have really agreed that climate change has actually reversed the path of economic growth, and that implications surrounding sustainability have direct implications for productivity and the future of productivity. That, of course, was a real turning point in contrast to successive industrial revolutions where we've witnessed carbon-emitting fuels contributing to manufacturing and industrial growth, consumer economies, urbanization, and transport. So after this tipping point, which is really encapsulated in Paris, the Paris Climate Agreement, and looking forward from Paris to the COVID pandemic, we also have this halcyon moment that was opened in 2020 when carbon emissions dropped by the single greatest amount on record. And many executives that were trapped at home said, we'll make commitments to net zero and we will accelerate these commitments. And so there's a question mark as to A, whether or not these commitments can continue to be delivered upon, and B, obviously now with Russia's invasion of Ukraine, we've been thrown a dose of humility with regard to the role of the pace of the energy transition, the role of oil and natural gas and coal in our economic growth, in developing and advanced economies alike, as well as our continuing resource dependence with one another. So, Jason, I have a question. So where do we stand now? There are a lot of claims that the Russia-Ukraine conflict can both accelerate and potentially decelerate the energy transition. What are your thoughts?
Well, thanks for the invitation. It's great to be here. I think that's probably both true, and I tend to be somewhat pessimistic and glass half empty when you look at the scale and magnitude of the global energy system and think about how daunting and challenging it is to think about goals like net zero 2050 or 1.5 degrees warming and take them seriously. I think you often see sort of optimism come from looking at how dramatically the cost of solar and wind are declining, or batteries are declining, or the growth of solar, the amount of investment going into it. The history of energy transitions hasn't been about energy transitions. It's been about energy additions, right? We meet the growth in global energy demand with different and hopefully increasingly cleaner sources of energy. But I think often what people fail to appreciate is that two things can both be true at the same time. One is that clean energy, zero carbon sources of energy exceed our wildest expectations for how quickly they will grow, and emissions keep going up. That's been the experience of the last decade plus. That's where we've been. So that leads me to, unfortunately, sometimes be pessimistic in how I think about how hard it is to get where we need to go. But I feel unusually optimistic in the sense that not because there's a horrific humanitarian tragedy taking place in Europe now, but I think it is sparking an acknowledgement of how far off track we are today from what it looks like to take a goal like net zero 2050 seriously. That is certainly going to mean that there's some additional, particularly if you want to take Russia off the table, which is the largest oil and gas producer in the world, there will need to be additional sources of hydrocarbon supply, and you'll see some investments take place in those. But I think it has the potential to catalyze a reminder that real energy security comes from being less dependent on inevitably geopolitically vulnerable hydrocarbon markets, right? I mean, I don't know what better reminder you need than the fact that the United States went from importing 2/3 of its oil use 15 years ago to being a net exporter last year. And we're still feeling pain at the pump, and it's a huge political problem when there's a disruption in Russia halfway around the world. So that, I don't know what better reminder you need that energy security comes not just from how much you produce or how much you import, but from how much you use in the first place. And we had this moment in the early 2000s when conservative national security hawks, like after 9/11 and the invasion of Iraq, conservative national security hawks came together with progressive left-wing environmental groups like the NRDC and worked together to try to push Congress to pass meaningful legislation and subsidies and all the rest to slash America's oil use, because oil dependence was a national security risk and it was an environmental risk. And then we sort of forgot the national security part because we had the shale revolution and we had lots of on a net basis, we became energy oil independent and the largest natural gas exporter, liquefied natural gas exporter in the world. So I think this has the potential to remind people that we're going to have to take some steps today that may seem inconsistent, like investing in new LNG terminals in Germany or something. But fundamentally, what's going to make Europe more secure and make all of us more secure is accelerating a shift toward other forms of energy, reduce dependence on oil and gas. And I wrote a lot about clean energy can have its own geopolitical risks, and I've written about those. We can talk about those. But to the extent you can improve efficiency, improve conservation, use less natural gas for home heating, reduce your dependence on imports, I think that we're already seeing that. We're seeing lots of governments pull forward their net zero commitments, pull forward their decarbonization targets in response to this crisis. It just doesn't happen overnight. You're not going to get through this winter or next winter by taking the 200 million homes in Europe and putting electric heat pumps in any. It takes time for that to happen, but hopefully this will accelerate it.
Thank you so much. So we're going to come to some more questions on the energy security piece and the geopolitical landscape. I'd love to turn to Professor Heal. There were many claims about, as we mentioned, there's many claims about this, the endangerment of economic growth from sea level rise and climate change. And I would say that probably even prior to Paris, there were many climate skeptics that continued to operate in the corridors of commercial power, and that continued sustained power shocks and environmental shocks have really transformed perceptions. So what are the ways in which climate change has negatively impacted economic growth across the globe?
A lot. This is a very short answer there. And it'll get worse. We're really only beginning. I guess in the last 5 years, we've begun to see fairly clearly the impact of climate change on economic growth. Let me give you some concrete examples. New York City here has 3 airports, right? LaGuardia is 4 feet above sea level. The one over in Newark is 6 feet above sea level, and Kennedy is 10 feet above sea level. 2 of those 3 will be underwater with high probability by the end of the century, probably before the end of the century. And the third one, Kennedy, will probably be flooding quite regularly by the end of the century. So I mean that all 3 of them will essentially be useless as international airports. Now imagine the amount of investment.
Kennedy's kind of useless now.
That's a separate issue.
Political statement.
It's a management issue, not a flooding issue. Yeah, but so imagine the amount of resources we're going to have to put into replacing those airports. Each of those airports is a multi-billion dollar construction operation. Each of those airports is 10,000 acres of flat land. Where do we find 30,000 acres of unused flat land somewhere close to New York? Where do we find the money to rebuild those kind of airports? That's an example of the way in which resources are going to be sucked up into replacing infrastructure, which is damaged by climate change. Okay, in that particular case, sea level. I was taking a class the other day, and I don't think any of you were in it, but some of you might have been. I brought up a map of southern Florida, which is color-coded for elevation above sea level. It's actually quite horrifying. Most of southern Florida could easily be underneath water by the end of the century. And that's sort of probably trillions of dollars of property there. Again, that means people will have to move, buildings will have to be rebuilt, we'll have to rehouse those people. All of this is a drag. All of this is a loss of capital stock, which is going to have to be replaced. So a lot of our economic activity will go into replacing capital stock, which is being damaged, rather than building additional capital stock and moving us forward. That's one of the main ways in which climate change is going to be a drag. Now, storms do much the same. If storms get stronger and more damaging, then they cause more damage to property, to infrastructure, and so on. Again, that all has to be replaced, and we're using up current labor resources, current output in order to. We're essentially running to stand still in cases like this because we're going to replace stuff which is damaged. There's a lot of evidence growing that, for example, people are less productive in a hotter climate. If you look at very hot days in the US, outdoor activities, people are much less productive. And even quite surprisingly, in indoor activities, there's evidence that people are less productive on really hot, steamy days. And we're going to get an awful lot more of those. I mean, by the end of the century, we could have 30 to 40 days a year here in New York City where the temperature's over 100 degrees, and much more as you go further south. So that's just a sense of a few of the ways in which this can be damaging. I mean, another one is quite interesting, is the spread of diseases. Disease vectors like mosquitoes are spreading, their range is spreading over the world. So we're getting countries which were not previously susceptible to malaria, to dengue fever, to Zika, to chikungunya, and so on, all of those diseases are spreading, which means, diseases, of course, lower people's productivity. They absorb resources to treat them. And so again, that's a spread of diseases as a way of reducing productivity. So this is a sample of the things that can happen, Alexis.
Thank you so much. So the arguments about LaGuardia we'll put to the side for the moment.
Yeah.
So thinking about shocks to economic growth, of course, inflation has been a critical one and dominant in headlines since the asynchronous reopenings of the economy, the shocks to production, the shocks to supply chain that we've witnessed. An estimated 350 million people suffered power outages last year for different reasons. Also helpful in this environment where many are comparing the potential outlook for 2022 to go back to the 1970s with double-digit inflation, stagflation. Important to be able to break down between headline inflation, core inflation, producer price input, asset and wage. These are very different things, but one thing with regard to the commodity markets is we see an immediate pass-through of some of the headline elevated fuel and food prices into the core consumer price index, passing through to key critical things for households such as power generation, such as transport, etc. We also witness in global commodity markets a co-movement has been very discernible between liquid fuels, metals, and foods over the longer term. So now what we're witnessing with regard to the conflict with Russia-Ukraine is elevated food prices off the back of already historically elevated food prices, and again, for different reasons. We'll get into some of the social aspects of this inflationary environment later, but I do want to turn to both Jason and Professor Heal to speak a little bit about the relationship between inflation and the commodity markets, what the outlook might be for the rest of this year.
Inflationary outlook. It's sort of paradoxical. I mean, the transition away from fossil fuels should in principle be good for price stability, because we know that wind and solar are less expensive than fossil fuels as a source of energy. So if we're moving away, I mean, one of the reasons the market is moving quite rapidly away from fossil fuels and towards wind and solar, or was before the mess in the Ukraine, is that just that wind and solar are less expensive than fossil fuels. So a lot of utilities were essentially voluntarily moving in that direction, and that's important. So in the long run, moving to wind and solar is going to stabilize energy prices. And as Jason indicated, it's going to also make us less dependent on imports and less vulnerable to price shocks, which I think is another important dimension there. But in the short run, obviously, there's an inflationary impact here because fossil fuel prices are going up. And as Jason said, again, it takes a long time to get away from fossil fuels. Even if you decide right now that you want to replace every oil-burning furnace in the US by a heat pump, it would take years to actually do that. And there's a whole supply chain issue in getting that done effectively and relatively quickly. So I think there's a short-run bump to inflation, but a longer run, medium to longer term drop in inflation, at least as far as energy prices are concerned. Now, the other thing we have to worry about a little bit is the potential inflation in the prices of the commodities they go into, things like batteries, shortages of nickel and lithium and so on. Obviously those prices have gone up. I'm not hugely worried about that in the long run. I think that the supplies of all of those things will increase. There's actually plenty of lithium around. You have to find it and process it and build processing plants. And also there's a fair amount of evidence that new battery designs are emerging, which will be less intensive in some of these scarce materials. So I think over 3 to 4 years, these shortages will go away. But again, in the short run, there can be price pressure there too.
Thank you. Jason, you worried about greenflation?
I'll let economists like Jeff speak to the inflation outlook. Obviously, high oil and gas prices contributes to that, and I have been writing a lot lately on how jagged and messy and disorderly this transition is likely to be, and what we've seen in the last several years, I think, is a risk that you approach supply and investment in oil and gas as if you're on track for your climate goals, but you're not actually on track for your climate goals. And then you have underinvestment that can lead to higher prices and that can worsen in inflation. We have grown to expect that Solar costs, for example, would decline year after year after year. They've gone up the last 2 years. And I do think the inflationary pressure of dramatically increasing demand for clean energy inputs, battery inputs and solar and everything else, combined with all the other supply chain problems we have for a variety of other reasons, is certainly pushing up some of those prices. And I'm curious to hear others' thoughts on, Jeff is somewhat sanguine because we can resolve that in a couple of years. It takes 10, 15 years to bring a new lithium mine online. So I think you're right that those pressures will subside because there's more than enough supply out there and the new battery technologies are really exciting. I don't know how long that period of disruption or dislocation will be before that starts to sort itself out.
Thank you so much. So to drill down into a little bit of the energy mix, Shaya, nat gas has been touted as the bridge fuel to bridge us to this cleaner, greener future, to bridge us to net zero. Even prior to the price shocks that we've witnessed from the fall of last year, and then, of course, the Russia-Ukraine conflict, nat gas has really been touted by many investors as being a cleaner alternative in the energy landscape. Can you shed some light on the role of nat gas in this whole energy transition?
Sure, and thank you for having me. Before I do that, I just want to go back to the comment on inflation. I take a slightly different point of view, and that's maybe because I have a slight advantage versus academia, where I don't have to be right in the absolute. I just need to be more right than the market when it matters. I think there's two structural things to unpack when it comes to inflation. The first has to do with the lag between supply response and demand. And I think Jason alluded to this. I remember as a student, as an economics student, people talked about overshooting in the agricultural market. Why? Because the farmer sees the price of tomatoes this year, price goes up, and then next year, when the harvest comes in, they've overplanted tomatoes, but then everybody's overplanted tomatoes, so you get a crash in the price of tomatoes, and then you have this structural overshooting in the market in what is economic theory would hold a rational market. So I think that plays a huge role in inflation, and maybe we can come back to that later in the conversation. The second thing, and I think this is critical as we talk about clean energy, and I'll talk about transition in a moment, all the renewable, not all, the majority of the renewable sources today fundamentally flow into electricity generation. So if you think about solar, you think about hydro, you think about wind, et cetera. But it's really interesting, if you go back and look at the history of electricity use in the industrialized countries, particularly in the US, electricity as a share of energy consumption in industrial uses has been pretty much flat at 15% for 30 years, okay? Why is that? Well, the reason for that is that you cannot, the density of energy to store electricity is, there's just nothing been invented that would allow us to fly an airplane on electricity for long haul, and you can go on and on, long haul transportation, et cetera. So one of the biggest challenges, and we'll get, the transition part of this, is that you cannot, with present technology, effectuate a transition. So now let's talk about your question. What are we transitioning to and why? Well, when we talk about natural gas, there's about 75% of natural gas demand today that there's really no technology that you can transition away from. For example, there is no technology that I'm aware of that's commercial and economic to produce steel from hydro or from solar or from, any of the many other renewable sources. So 75% for the moment of natural gas is here to stay. The other 25%, you could displace for electricity use. Then the problem becomes, what are you transitioning to? And I think here, what's interesting is that if you look at renewables and you look at, wind and solar, particularly in the United States, there's a transmission problem. Because if you look at the Princeton study on net zero, you would need a 25-fold increase in installed capacity, and you would need a 7-fold increase in the wires, the transmission distribution, to get that power that's generated from where it's generated in the middle of the country where the wind blows and the sun shines to the coastal areas where we consume electricity. So net, that's a real problem when you think about transition. So you do need natural gas, and I would say, yes, it is a transition fuel because A, it's cleaner, B, it's cheap. I mean, maybe not so much at the moment, but generally on a gigawatt hour basis conversion, it's about 6 times cheaper. And then number 3, it actually, for relatively clean fossil fuel. It has half the carbon emissions of coal. It has about 80 or 90% less NOx and SOx emissions. And it also doesn't have the mercury. So a lot to unpack in there, but, short answer is yes.
Here's a quick question, sorry. The 75% of gas, I think in Europe, 25% of gas is electricity.
Yes.
And I totally agree with everything you said on the heavy industry. We don't know that's hard. But the biggest chunk, 40%, is heat. And that technology exists. We know how to do that. It just takes time. So you made a comment, we didn't have the technology to get off 75% of gas. The biggest gas use in Western, somewhat cold environments, I think, is heat. And that, we do have the technology, right?
You are correct. I was referring to the U.S. About a third of the U.S. is power gen.
Okay.
The other third is industrial use. And then the remainder is, a bunch of other things. And so the industrial use is the hardest part to replace. And then you can actually move off the entire grid to renewables because you just don't have the storage and reliability today to be able to have 100% of the grid.
Yeah, totally agree with that. Yeah.
Offshore wind is actually quite important in that context, isn't it? Because the offshore wind that's going up off the coast here will actually be much closer to demand centers than the traditional wind farms in the middle of the country. So that's the logistics is easier there. You're absolutely right, obviously, the gas is cleaner, but one of the problems we do have at the moment is massive leakage out of gas networks. And methane, when it gets into the area, is quite a powerful greenhouse gas. So I'm sure that's a problem which can be corrected, but it requires a bit of investment and a bit of effort there.
Mm-hmm. Thinking about the role of nat gas in final energy demand, that we are now getting to a critical state in even debates in Germany as to whether industries or households need to switch off first in the event of shortages. So that is how critical we are today. So turning to that geopolitical landscape, and Jason, we had a great, fantastic event over the years about the GCC and the role of the Middle East in global energy markets. And after Russia, looking to the home of the world's largest reserves of natural gas, some of the lowest cost production of natural gas and oil in the world. Many advisors and commentators had written off the future of the energy exporters in the Middle East in the light of the green light of the energy transition. And now, of course, one might say that there is a revenge of geopolitics and the return of geopolitics in global energy markets. We've seen significant shuttle diplomacy with some of these exporters, the heads of some of these countries, cementing long-term contracts in Germany, coming to the White House, cementing long-term contracts across Asia. What is your outlook for the energy exporters? Is this just a flash in the pan response to the present crisis, or will these countries have a role to play for decades to come?
Yeah, I wrote an essay in January in Foreign Affairs and then an op-ed in the New York Times in January, so right before the invasion, sort of along this theme, because my research interest has been the geopolitics of the energy transition. There's a lot of focus on the geopolitics of climate change and how significant worse floods and storms and droughts and refugees and migration will be. And then when we talk about the geopolitics of the energy transition, to your question, I think it was often kind of a discussion of an end state. I remember being at the Munich Security Conference a few years ago, and we were talking about Nord Stream 2, because that's what you do every year at the Munich Security Conference. And somebody said, I don't know why we're talking about this anymore, because renewables are growing so quickly, we're not going to be using gas soon. And it seemed such a misguided comment to me, because you were talking about an end state when you are in a zero carbon world. First of all, the IEA has told us at least one modeling scenario, you can quibble with it, but even the IEA's net zero 2050 scenario, when we get to net zero in 2050, the world's using a quarter as much oil as today and half as much gas as today. Not zero, it's still big numbers. So not really zero. But then the idea is petrostates collapse and there's no business model because nobody needs oil anymore. What was interesting, that's really far away. And by the way, we might unfortunately fall short of those goals. But the question is the process of getting from here to there, the next 10 years, 20 years, what does that mean? This process of transition, which hasn't even started yet. Oil demand's still going up every year, but imagine it begins. And part of the argument we were making in that piece, my co-author Megan O'Sullivan at Harvard and I, was it could well mean feast before famine for petrostates. And I think we're starting to see that prediction play out. And what motivated us to say that was a little bit what I said a moment ago, a combination of significant social pressures to discourage investment in fossil fuels that are, affecting people, on the other end of Manhattan and large financial institutions. So we're seeing pullback in capital investment in hydrocarbons. even though demand was going up, not down, those supplies have to come from somewhere. And so that creates an opportunity for state-owned, and only 15% of the world's oil and gas is produced by the dominant major oil companies you've heard of every day, the BP, Shell, most of the production comes from state-owned enterprises that are much less susceptible to those social pressures or the need for financing from, say, Wall Street. So that creates an opportunity to increase a share of a potentially smaller but still very large pie that comes from petrostates. And second, particularly for Gulf producers, as you know, the influence that Saudi Arabia has in oil markets is not just from how much it produces, it's particularly its willingness to hold spare capacity. At a cost to itself, not insubstantial cost, it is willing to not produce all the oil it can. And that means that when you need some extra supply, as we do today, there's not that many places to look. You can go to an Iran deal, you can call Venezuela, you can call Saudi, the options are not great, or Texas, we can come back to that. And so the ability to take that call from Democrat and Republican presidents for administration after administration is a big part of where the geopolitical influence, in my view, that the kingdom has in oil markets. And that's not going away. That is going up, not down, although they don't have that much spare capacity today.
Thank you so much. It's interesting. Yes, please.
Yeah, I'd like to just add to that. I mean, I think Jason's quite right. I think that the sort of scenario of the oil countries fading away has been much overplayed. That even on the most optimistic estimates, there will still be billions of cars in the world, billions of trucks in the world by 2050 which are using oil. Because even if all new cars being sold then and new trucks being sold then are electric, for example, there'll be a huge stock of old ones which will still need this. Aircraft will still need oil. There'll still be plenty of buildings that haven't been retrofitted which will need heating oil. So there'll be a big market for oil to the middle of the century and beyond. And what we'll see, I guess, is that the high-cost producers will drop out, and it'll be dominated by the low-cost producers. And those low-cost producers are all the ones in the Middle East. So we'll build, I think the Middle East will be in the oil business and quite influential there for another 30 to 40 years.
And to your point, low cost and low emission footprint, which they also look pretty good on methane and flaring rates.
It's interesting, actually, when we look at some of the Japanese auto manufacturers, there have been very clear choices to continue to produce cars with combustion engine, that there will be a whole range of customers. Right. When you look to a country like India, and you look at the trajectory of moving from pedestrian to bike, to motorbike, to car, to lorry, to jet fuel, certainly I think many are focused on this.
Well, that point about developing countries is important there because to electrify vehicles, you need an electric grid. And a lot of developing countries just don't have an electric grid. So you really cannot provide the kind of power needed to charge an electric vehicle in a country which doesn't have an effective electric grid.
Yeah. When we were speaking last week, you spoke about the extraordinary amount of electrification or power generation that needs to go into the electrification of transport as well.
Yeah, right.
And that energy returned over energy invested.
I mean, the net zero scenarios, it's like 2 to 3 times today's electricity use, right? I mean, it's a big increase. Yeah.
So to come to that, I do want to look at the U.S. landscape a little bit. Shaya, when we met a decade ago, the production of U.S. shale oil and natural gas were critical linchpins and part of this energy independence. And Jason's seen it on both sides, and Professor Heal's seen it on both sides. The left and the right, the Dems and the Republicans, have all chased this holy grail of energy independence, particularly since the energy price shocks of the 1970s. In your experience over the last decade, has some of the climate activism, particularly things like the announcement of Biden's campaign trail, Green New Deal, thrown some of this into jeopardy? And now has that course been charted and reverted back with this current crisis?
It's interesting because under President Nixon, there was a task force that was formed. It was called the Independence Project. And then pretty much every single presidential candidate since, and he, by the way, under the Independence Project, committed to being energy independent by 1980. This is in the early 70s. Every single president, with the exception of the current administration, has made it a hallmark of their election campaign to deliver energy independence. And there's a funny group of people in Texas called Oil Men for Obama, because it was under President Obama, actually, that we became energy independent. Now, what does that mean? I think it means a lot of different things to different people. But Jason touched on this earlier. There's a lot of different ways to measure it. If you look at the amount of resources we've commercialized in the last decade, it took Saudi Arabia 20 years to add 5 million barrels a day. It took us about 7 years to do that, to accomplish what Saudi did in 20 years. And it was a combination of ingenuity of American technology plus private mineral ownership plus the capital markets. So I think the answer to your question is it's not so much administration dependent. I would say that the oil market is today marching to the drumbeat as it has been for the last 30 years, which is the capital markets. When we think about what shapes supply, conventional economic theory would hold that when capital-intensive industries generate high rates of return, they attract capital. When they generate low rates of return, they repel it. I think there's a footnote in there. It's the capital markets right now, and for the last 40 years, that have been shaping it. What I mean by that is when large institutional allocators, pension plans, sovereign wealth funds, mutual funds, et cetera, endowments like, endowments of universities, when they decide that energy is a core allocation, the spigots open and money flows, and then money determines CapEx, and CapEx determines supply. That started in the US in the early 2000s because we came out of what's called the lost decade. You were going to touch on talent. I think it's really interesting to come back to that later, but the lost decade was really atrocious for anybody in the energy industry. If you put $1 in energy, you got 60 cents back. 10 years later, you put $1 in tech, you got $9 back. Can you imagine for 9 years losing money? It's a very unpleasant experience. And so what happened is money flew out, and then in the early 2000s, it's all reversed. So under the current administration, I think there's a lot of rhetoric, as there is with a lot of other of the Green New Deal initiatives, but the substance really hasn't had an impact. And today, even if you look at the numbers, despite the high oil prices, energy consumption to GDP in the US peaked at around 13 or 14% in the 1980s. We are today at 3%. Europe is about 11%. And I think one of the things that gets lost in the shuffle with all the headlines about high energy prices is, in a very paradoxical way, energy prices are net positive for the US economy. They're not great for Europe, and they're not great for all industries in the US, but taken as a whole, GDP and employment benefits. And I would say that's a great sign of energy independence.
Thank you. I do want to turn to this, you're touching on this concept of underinvestment, because we have seen a lot of commentary going back to 2021, the price shocks, the supply shocks, and some very powerful investment banks making the case that this is the revenge of the old economy, that it's decades of chronic underinvestment in fossil fuels that have led us to this point. I know each of you have something to share on that, so I want to turn to you. And I also then want to ask Shaya, too, therefore, are we now in need of a lot of ESG de-risking mechanisms to be able to stimulate flows to some of these longer-term projects, such as Jason hinted, if we're going to put LNG import terminals in Germany, but pension funds that are going to allocate there that will last longer than the Schultz administration, how long, what are the types of guarantees that could be put into place?
It's a funny business when Washington dictates investment and Wall Street dictates policy. The guaranteed outcome is market distortions. And I think we're sort of in that environment. And if you look at Google searches of ESG investing, so you can go to Google and type in, search frequency, you will quite literally see an exponential growth starting in 2014. And if you go in and you look at fossilfree.com and you type in divestment commitments, you will see a commensurate rise in the number of AUM-controlled entities that have pledged to divest. So I think, the ESG, this is probably a lot to unpack, but I think in a nutshell, I think the problem is when you try to price in an externality into supply without separating out the cost of the externality and putting a carbon tax or putting the capital markets are great at pricing things. Tell me what the bad thing is, and I'll put a price on it, and I'll trade it, right? That's what the capital markets do. But when you try to make the capital markets a forum to punish or reward based on non-price-driven signals, you get some very, very discongruous events. So you're talking about ESG de-risking. I think it's quite simple. There needs to be a market where you are paid to remove carbon. And I think the greatest piece of clean energy that's not being talked about is, in our view at least, it is an impossibility, and this is the bad news, to get to net zero. And why do people talk about it? Because the average tenure of the politician and the average S&P 500 CEO does not live long enough in the corporate office to get to 2050. So it's not only not their problem, it's the next CEO's and the next CEO's problem.
Except in the kingdom she asked about. He'll still be there.
Yes, definitely.
I'll save that for Chatham House. But the fundamental thing that I think we're missing in the market today when you talk about de-risking is if we were to come up with a system to price this externality and then allow investment to flow to remove the carbon, I think you would see a very powerful impact on the
This is
environment.
coming through from a lot of the majors, the CCUS, all of the extraordinary innovation that's happening in the space, and certainly at recommendations of the IMF. Jason, Professor Heal, anything to add on this?
Yeah, I totally agree with what Shai just said, obviously. Yes, let me just say amen to it. But in addition to that, there's an interesting development recently. Stripe is leading a consortium of investors to create a market for carbon removal. I'm sure everybody's read about that. There's a few $100 million been pledged to this. The idea that there's a bunch of nascent technologies out there for removing CO2 from the atmosphere. Something which can be done, but it hasn't been done on a large scale at all yet. So there's a lot of work to be done to make it viable. And so what a bunch of investors have done is pledge a couple of $100 million to purchase, to pay any company which comes up with a viable technology to remove CO2 from the atmosphere. So the idea is they're trying to create a market, do exactly what Shai was saying, actually, trying to create a market for carbon removal. That was done quite successfully by Gates and his Foundation for Vaccines. Some of you are probably aware of that. Gates, when there was a shortage of vaccines for various diseases in developing countries, rather than subsidize the R&D, what Gates' foundation did was say, we will spend $100 million buying the first vaccine that's effective for disease X. And that guaranteed that whoever came up with that vaccine would have a market for it and make some money out of it. So they're now doing the same thing for this technology. And I think it's actually quite a smart move. And it was only announced last week, so we don't have a lot of detail on that yet. But it's very much the kind of thing that Shai was asking for, actually.
Thank you, Jason.
I can comment on this question if you want, but I just want to highlight something Shai said before, because it should blow your mind. Higher oil prices are better for the U.S. economy. I don't think we've wrapped our head around the implications of that. We, 50 years ago, dealt with an oil crisis by creating a government instrument, putting oil in salt caverns, to say when we have disruptions in supply, and right now disruptions don't mean shortages, it's not that you can't get it, it means prices go up all around the world. It's an integrated, flexible commodity market. And then we release these stocks to bring down the price. That's a public good, because it brings down the price everywhere, not just in the US. And the implications of what he's saying are do we even want to do that anymore? What we care about now are the distributional impacts, the impact it would have on the consumer or on households. But on a net basis, play out his argument, not just today when we're basically a net zero exporter, but roll the clock forward. Imagine we do what we should be doing on electric vehicles and fuel economy. The world is still using a lot of oil. Shale oil has some benefits to it in terms of its flexibility and short cycle nature. It's kind of almost designed for an energy transition because you need it today, but don't want to have a sunk investment, tomorrow. You could imagine the U.S. being a very large net exporter of oil, in which case the potential benefit to the U.S. economy of higher prices could be significant. And then you have to think totally differently about the policy tools that you need to sort of figure out how do you deal with the distributional concerns you have about high energy prices in the U.S. But maybe our policy goal won't be lower prices, which is just almost impossible to wrap your head around, given that it's obsessed policymakers for a half century.
And also all of our infrastructure is still geared toward importing oil rather than exporting oil, so there's a lot of investment that needs to happen.
Yeah, that's a real irony. Can I just add one point? We were talking about underinvestment in oil capacity, oil and gas capacity. Part of the reason for that, obviously, is divestment and ESG, but there's also another reason, which is that during the shale boom from, sort of 2013, 14 onwards, until just a couple of years ago, the shale production was increasing very rapidly, but profits weren't. And a lot of those shale operations were actually unprofitable. And that was sort of hidden in some ways by creative accounting. Wall Street really only caught up with that in sort of the late teens, started cutting back capital allocation to the shale industry. And now they're putting much stricter discipline, financial discipline, on shale oil and gas producers. And that's one of the reasons that that sector isn't getting money as easily as it could back in 2015, 2016, when you could basically, you could fund
you were
anything.
making that
any
point.
kind of
Shia, I'm
oil.
going to give you the opportunity to respond to this.
I think the technical term on Wall Street they used for that was called half-cycle
Yeah.
economics. And the problem with half-cycle economics is it only tells you half the story. Essentially, you're making assumptions about value recovery 10, 15 years down the line, and you need a panoply of Excel assumptions to manifest 10, 15 years down the line in the commodity industry. And in the meantime, you've got cost inflation, you've got expensive assets that you're buying, you're putting a lot of money into them. And I think, quite frankly, one of the things that we worry about as we think about the climate, because it's unquestionable the planet is warming, as you pointed out earlier, and that fossil fuels are a contributing factor. The issue that we have when we look at this is that you're seeing that same half-cycle accounting now in clean tech.
Sure.
And so that's one of the challenges that leads to overinvestment and underinvestment on a sustained basis.
You see it very clearly in nuclear too, incidentally.
Sorry?
You see it very clearly in nuclear.
There's not a lot of nuclear investment, but yes, you see it all over.
Yeah.